Welcome to this explainer. Okay, today we are going to completely shatter everything you thought you knew about business success. We've compiled data from top financial experts to really reframe how you look at the overall health of any company.
So let's dive right into this totally counterintuitive question. Can a highly profitable business still go bankrupt? The answer is a resounding and honestly terrifying yes. It sounds impossible, right? Like if you're turning a profit, you're winning. But focusing solely on the bottom line of an income statement, well, that's a dangerous trap that has brought down countless founders.
Here's the crucial point. Profit is really just an accounting theory. It's based on when sales are recorded. But cash flow, that is the hard financial reality of what is actually sitting in your bank account right now. Think about it. If you close a massive $2 million deal, your income statement is going to show a huge profit today. But if that client doesn't actually pay you for 60 days and your payroll is due tomorrow morning, yeah, that paper profit is absolutely not going to save you.
Section 1. The illusion of profit. Check this out. According to a study by U.S. Bank, a staggering 82% of business failures are linked directly to poor cash flow management, not a lack of profit. That means 8 out of 10 businesses that are forced to close their doors aren't necessarily failing because they've got a bad product or even a lack of sales. They're failing because they simply misunderstood their cash position and literally ran out of oxygen. So for any founders listening right now, this is exactly why you absolutely cannot afford to take your eyes off your bank balance.
Because, let's face it, a profitable balance sheet means absolutely nothing when you physically cannot pay your suppliers or your employees. There's this kind of grim saying in the financial world, when a business fails, the balance sheet dies last, but the bank balance dies first. Hitting a cash flow wall is pretty much a founder's worst nightmare.
Moving right along to Section 2, the bathtub mental model. So to really wrap our heads around how money moves, imagine your business is a bathtub. The water inside the tub, that's your stock of resources. The faucet is your cash inflow, and the drain is your cash outflow. It's such a brilliant way to simplify the whole shebang. If the water level in your tub is dropping, well, you really only have 3 options. You can turn up the faucet, you can plug the drain, or you got to do both, because otherwise you're looking at a flooded floor and an empty tub.
But here is where this analogy gets even deeper. You actually have different types of tubs. Like, if a renewable stock, let's say customer goodwill, drops because you made a mistake, you can apologize, offer a discount and fix it. That is a renewable tub. But a finite stock, like your cash reserves, that has to be guarded so carefully. You can't just magically refill it when the bank account runs dry during a lean month. Once that cash tub is completely empty, the game is over.
All right, Section 3, the 3 cash flows.
Here's the deal. Every single dollar that enters or leaves your business gets sorted into one of 3 distinct categories. Honestly, it doesn't matter if it's a massive bank loan or just a $10 run for office supplies. It all falls into operating, investing, or financing. Let's break these down.
First up, operating cash flow. This is the absolute heartbeat of your business. It tracks the actual money you collected from customers, minus the cash you paid out for rent, utilities, salaries, all that day-to-day stuff. This is your core engine. If this number is consistently positive, it means your core business model is actually working and can sustain itself. But if it's negative, your daily operations are actively bleeding cash.
Next, we've got investing cash flow. This one tracks where you're putting your long-term money. Like, say a company buys $20,000 in new equipment to fuel their future growth. Now, unlike your daily operations, a negative number here isn't necessarily a bad thing. If you're out there buying machinery, vehicles, or software to expand, that cash is going out, which gives you a negative investing cash flow, but it actually means you are building for the future. And the third one is financing cash flow. This tells the story of your external money. It tracks the whole push and pull of bank loans, investor funding, and paying off debt. If you take on a massive loan, cash is coming in, so that's a positive financing cash flow. But remember, a healthy business really aims to rely less on this external life support over time and a whole lot more on its own internal, self-sustaining operating cash flow.
Which brings us to Section 4, the deadly growth trap.
Take a look at the data here for ABC Business. Over the course of 3 months, their net profit steadily climbed to over $19,000. Great, right? Well, look closer. Their actual cash balance plummeted to a negative $54,000. Why on earth did that happen? It was because of delayed customer payments and upfront supply costs. They were paying their suppliers in 30 days, but letting their big corporate clients take 60 days to pay them. So the faster they grew their sales, the deeper into the cash hole they dug themselves. Basically, their growth literally consumed them. Financial expert Jagmohan Singh hit the nail on the head when he said, "Profit is a theory. Cash flow is reality." It perfectly captures this trap. If you track your profit but totally ignore your cash, you're basically building a castle on sand. You might be popping champagne over record sales months, but if the actual cash isn't hitting the bank, it is just a theory on a spreadsheet.
Okay, last section. Section 5, protecting your cash flow.
To survive, you absolutely must avoid these 3 major mistakes. Number 1, taking weeks to invoice. Number 2, buying expensive machinery without a real cash strategy. And number 3, letting those accounts receivable pile up. Seriously, it is astounding how many businesses bend over backwards to deliver this amazing service, and then they wait 2 weeks just to send the bill. Every single day you delay sending that invoice, you are literally starving your own cash flow.
Fixing these simple collection habits is, for sure, the fastest way to strengthen your liquidity. And the best part? You can do it without ever needing to raise external capital. Just by tightening up your terms, sending friendly reminders, and actually tracking your metrics, you can completely transform your business from constantly stressed out to totally self-sustaining.
So I'm going to leave you with this provocative thought. Take a really hard look at your actual cash runway today. Because at the end of the day, it's not about how much you sell, it's about how much you keep. If your customer collections suddenly slowed down by just 10% tomorrow, would you still be able to make payroll next month? Understanding the answer to that question is the true mark of financial mastery. Thanks so much for joining me for this explainer, and remember, keep your eye on the real numbers.